Hello, I'm Michael Hainsworth. Investing internationally has typically been about diversification. With a handful of companies making up the majority of the movement of the S&P 500, however, it's no surprise Canadians are looking abroad. But it's not just about taking eggs out of the Trump basket, so I wanted to introduce you to Peter Rozenberg. So if there was one thing you wanted the listener to walk away from our time together today, what would it be?
It's that diversification in a global portfolio provides better returns with lower risk. And really, that's the key underpinning of good investing to me.
On this episode of On the Money, we'll make the case for going global, assess the risks, and give you concrete advice on how to evaluate your next international move. But first, knowing the difference between a bull and a bear isn't just trivia, it's strategy. A bull market is about optimism, rising stock prices, expanding economies, and growing investor confidence. A bear market? That's fear. Prices falling, confidence shaken, a lot of people wondering if they should bail out. For millennials, these aren't abstract terms. They've lived through both. From 2009 until the pandemic in 2020, we saw the longest bull market run in history. Tech stocks soared, new companies went public, and retirement accounts swelled. Then COVID hit. Within weeks, markets tumbled more than 30%, a textbook bear market. But here's the twist. It was one of the shortest bears ever, as stimulus spending and innovation pulled the market back to all-time highs. Understanding these cycles matters because bull and bear markets shape our behavior. It's tempting to chase trends, overextend, assume the good times will never end. In a bear, it's tempting to panic, sell at the worst possible time. Both reactions hurt you more than the market itself. Smart investors don't just ask, is this a bull or a bear? They ask, where are we in the cycle? And how should I respond? In bulls, it may be about rebalancing, taking some profits and protecting against the next downturn. In bears, it may be about staying disciplined, adding to quality positions when prices are low, and remembering that history shows that every bear eventually gives way to a bull. So knowing the difference between a bull and a bear isn't just trivia. It's strategy that helps keep perspective, stay disciplined, and see opportunity when others only see risk. Peter Rozenberg is an international man, but there's no mystery to his success. He's got a concrete model for investing outside of Canada. Are you getting into a region or into an equity that just happens to be in a region?
Our process is more so a bottom-up process where we're trying to find the best companies in the whole world. And so in that context, it doesn't matter where we find them. When we think about global investing, it's expanding our opportunity set rather than say, I want to be in such and such country. Now, there are instances where you can say there is a better opportunity in such and such country like Germany to the extent that they will be priming their economy with large investments, but more so it's a bottom-up process.
So then you're looking at whether or not the company has high margins, high returns, strong free cash flow, I guess a dominant market position, that sort of thing. What is a perfect example for you right now in a bottom-up approach?
That's exactly right. So a good example of that would be a company like Rolls-Royce, for instance. We have underlined that the aerospace market is a tremendous market. And the reason for that is we're at the bottom of the cycle. And part of this is because of COVID, which limited the amount of airplanes that could be manufactured. And the underlying market is very attractive because the propensity to fly is constant and it's a function of GDP growth, which historically has been about 1.2, 1.3 times. And so we're in a tremendous position here. So looking at Rolls-Royce, the reason why that's interesting is because the narrow body demand for aircraft has continued to grow, whereas in the future, we're going to see an acceleration in wide body. And to the extent that Rolls-Royce is better positioned there, that's an attractive way for us to go into the aerospace business. Similarly, we can take advantage of valuation, and then there's also optionality because they are also providing nuclear reactors, which prospectively could be very attractive.
It's interesting that you bring up aerospace specifically and Rolls-Royce out of Europe, because I would think, and I can imagine a lot of Canadians with their home country bias or their home continent bias would just go to General Electric.
Sure. And we own General Electric in our portfolios, and we own Howmet in our portfolios and Safran. But when we look at the opportunity set, we go, what looks best in terms of business position, margin, um, structure of the market? And then we say, where can we do that best? Those questions that we answer there are valuation, product line, perhaps. We were talking about narrow body versus wide body. In terms of valuation, we have an advantage also on Rolls-Royce. And then we said in terms of optionalities. So when we take it all into context, all are good. We love the aerospace cycle, but this is special, we think, and expands our opportunity set. And to the extent that it's different than GE, provides us a diversification benefit.
I mentioned the home country bias. How can we overcome that as Canadians, as investors, as advisors?
It's an excellent question. It's normal to buy things with which you have familiarity with. If you're a Canadian, you're likely looking at banks, you're likely looking at oil and gas, maybe to a second extent, mining. But I think the real question that we need to ask as investors is, what risk are we taking? What opportunities are we trying to find? And when we do it like that, we say, well, do we really want to be in banks? Banks are high quality companies in a Canadian context with moderately good returns, an oligopolistic position, but they have high financial risk, high operating risk, and they are cyclical. And of course, commodities are a function of the commodity, and those are highly cyclical too. So when we think about our risk, I think we have to say to ourselves, where does diversification fall within that? And then when we answer that question, we go, yeah, maybe I should be more in technology. Maybe I should be more in healthcare. Do I not benefit by being in other countries like the US and abroad? And then when we answer that question, I think the answer is simple. And the answer is yes.
So if more of today's growth stories originate from regions that have very different fiscal demographic tailwinds than North America, how do you know that the run isn't already done? How do you know how to deploy capital into a given region with expectations of long-term growth?
The issue with regard to risk that you're mentioning is a legitimate one. Europe historically has grown less. The US economy, I would say, is more dynamic than the Canadian economy. And we do have to balance those type of risks when we make our investment decisions. But to the extent that we're bottom up, we're going, what's the best companies? What's the best outlook? And then we balance again those issues with regard to geographic concentration or whatever other political or foreign exchange risks there might be.
So diversification may begin with geography, but as Peter reminds us, it's really about opportunity. From Rolls-Royce engines and the pivot into new energy to Europe's undervalued industrials, he shows how looking beyond our borders expands the investment canvas far beyond Bay and Wall Streets. But every new market introduces new rules and new risks. Political instability, opaque regulations, shifting demographics can redraw the map overnight. Political instability, regulatory opacity, these things can quickly erode returns. How does an institutional investor build risk premiums, or I suppose guardrails, as we could call it, into your model when governance standards vary widely?
If you don't know anything and you're buying an ETF that gives you exposure to a market, you'll have diversification, but you'll also encounter all of the risks that you're mentioning. And depending on the type of global investment you have, you'll be more oriented to one risk or another. And we mentioned in Canada, that would be banking and metals and mining and oil and gas. In the US, there would be larger concentrations in technology stocks. But the way, again, we think about it is where's the best opportunities, and to the extent that we're active managers, we will avoid those areas with high risk, and we will approach those areas with low risk, and always in the context of who's best positioned on a global basis to compete, who has the best margins, the best returns. So I think by excluding markets that we know are high risk, let's say like China, which is a communist country, or de-emphasizing markets that may grow slower, like France in the European context, through active management, I think we can manage those well. And then again, through looking at the companies themselves, where in those markets do they participate? Where is it high? Where is it low? And then making a decision on that basis.
How do you define an emerging market in a world where some frontier economies leapfrog traditional development stages? I think about places in India where they never had landlines. They went straight to the mobile phone and e-commerce, and the Western world was stunned to see that they were leagues ahead of us.
Because international investing does pose risks with regard to FX, political, we have to be very disciplined, and we have to say certain markets are for us, certain markets are not. And so we tend to focus, again, Latin America and Asia, advanced, United States primarily, and then Western Europe in particular. And so the best way to do it is to say, that's high risk. I'm not interested in being there. And again, the strategy is not, I want to be in every country for the purpose of diversification. The strategy is, I want the best risk-adjusted returns. Where can I find those? And so we're not in emerging markets for the most part. They have not provided good returns historically, although they do promise more growth.
Supply chain resilience, isolationism, they're rewriting the global trade maps right now. How should we as investors reassess sector exposure that once depended on globalization as a tailwind?
There are certain companies that historically had done well as a result of globalization. And so we need to avoid those areas right now. The one that comes to mind is test and inspection. It's a business that had done well historically in the context of an expanding global market that required more testing, more inspection in terms of importing. That business also had benefited from a strong demand for resources. And to the extent that we've seen moderation there, that had hurt their business. So yeah, we have to exclude some of those markets. But we look at it again in twofold. What's the risk in terms of globalization that can hurt the business? But what's the opportunity? And there, the opportunity set is big in terms of nearshoring in the United States, which is very attractive, increasing investments in non-residential construction, primarily infrastructure, which had been historically weak, is now set to be bigger. And the President of the United States has noted recently that there are commitments for upwards of $20 trillion in investment to reshore drug manufacturing, as well as semiconductor and other advanced industrial process. So that's the good side of the equation. So get rid of what's bad and take advantage of what's good, and recognize that the market has changed in terms of globalization.
You touched on currency ever so briefly there. So let's get a little bit into that, because I was always taught to believe that when you invest internationally and you have a diversified portfolio, the currency just ends up being a wash. Like it's not something worth losing sleep over.
Generally speaking, I think that's fair outside of emerging markets countries. But there are currencies that historically have done better. The US dollar, the Japanese yen, and I think the best one of all time is the Swiss franc. And so it's not coincidence, again, that those are the areas that we would emphasize. And again, we've said that for the most part, emerging markets pose larger risks and have not provided good returns to shareholders, so we've avoided that. But as a general rule, I would agree that currency is sort of secondary in terms of what we look at. But I think it's necessary to say we need to have at least a neutral view on currency. in order to invest in that market.
Risk isn't a reason to retreat, it's a reason to get smarter. Rozenberg's point about supply chain realignment and emerging markets shows just how nimble investors thrive when others freeze. But intelligence in global markets depends on execution. Knowing a region's risk profile is one thing. Knowing a company's margins, returns, free cash flow is where performance meets precision. So I want to get tactical here. I want to talk about how to separate the truly dominant businesses from those past their prime. So you told us at the beginning of our time together that you evaluate a company based on its margins, strong free cash flow, market position, industry underpinning. So let's sort of start at the top here. How do you define high margins in an inflationary world?
So in a simple way, high margins are 10 to 20%, or more, and margins under 10 are lower. And what's the implication of that? Why is that important? Why do we focus on that? Because that's what gives you the margin of safety. If inflation goes up, if economic performance goes down, if there are problems in the underlying markets, our ability to offset those comes from our higher margin. But they do something else too. What they do is they underpin returns. An important underpinning of ROE, which is an important underpinning of valuation, is margin. And then the last thing that the margin tells us as an indicator is it doesn't lie. If someone has a high market share and they are not getting a high margin, then clearly the business is too competitive, or perhaps they are not a leading business. So those are the indicators for us, and that's why it's so important, because they underpin return, they underpin free cash, and those are the underpinnings of valuation.
You never want to hear the CEO of a company say, "How do we do it? Volume." That's not the way you go.
Exactly.
So how do you define strong free cash flow? And I suppose more importantly, has that evolved during these unprecedented times?
What underpins valuation is what Professor Gordon said underpins valuation. It's free cash flow. He went further and said that the underpinnings of the free cash are coincidentally ROE, your discount rate, or your risk, and your growth rate. And if you assume that growth is sort of fixed at 4 to 6% over the long term, something coincident with economic growth, and you assume that you want, let's say, a 10% return, then everything is ROE. And if everything is ROE, and we said that ROE is an important underpinning of free cash, then free cash is what matters. And so companies that don't have to invest a lot in order to get a return are better than others. And so more free cash is better. 20% is a strong number. 10% is a good number. 5% is not. By the way, the best Mag 7 companies in the US are 20%. It's unbelievable.
Well, let's sort of tie into the Magnificent Seven right now, because I remember a time when Netscape Navigator was the world's most popular web browser. I remember when BlackBerry made smartphones. I remember when we would spend Friday nights at Blockbuster picking out a movie. How do you assess dominant market position when first mover advantage is not always an advantage?
I'm old like you, so I'm well aware of these, and I've seen the movie BlackBerry. I don't know if you have. It's a Canadian tragedy, but it does underline, these issues. And I was thinking about them as I was watching the movie, because that's really the core issue. When we say we want high margins, they need to be sustainable. That's implicit, right, in how we're thinking about it. It's not okay to say my margin is 20 if tomorrow it's 5 because there's an economic decline. So we want sustainability. And so what are the questions that we ask in terms of sustainability are, well, first, let's start at a high margin. So just to start, ask, is the business cyclical? Look at the historical cyclicality of the business. Look at the operating leverage of the business. In other words, how are the earnings impacted by changes in sales? By a lot or by a little? And when we answer those questions and we look at market shares and we look at the quality of their products and we look at the competitive market, we are better able to answer those questions. But no, there's no perfect answer. And, life teaches. But hopefully, if we do our analysis correctly, we know what the underpinnings of our thesis are. And our job is to say, how is that thesis changing every day so that we can change if the market changes faster than we expect. But if we have high margins and high returns, then we've bought a quality company and we have some margin of safety to start.
So if there was one thing you wanted the listener to walk away from our time together today, what would it be?
It's that diversification in a global portfolio provides better returns with lower risk. And really, that's the key underpinning of good investing to me.
Peter, this has been fascinating and very insightful. Thank you so much for your time.
Thank you very much. I really appreciate your time.
Peter Rozenberg reminds us that international investing isn't just diversification, it's discovery. Going global opens doors to opportunity sets that Canada alone can't provide. But as we've learned, opportunity and risk travel together. Political shifts, currency swings, changing trade dynamics demand a disciplined hand and a clear framework. And when it comes to execution, it's all about the fundamentals. High margins, strong free cash flow, dominant market positions, they all stand the test of time. Because in the end, global investing isn't about chasing what's new, it's about finding what endures. And now you're on the money. I'm Michael Hainsworth. Thanks for joining us.